Hello there everyone. Today's video is all about goodwill amortization. Now, let's just take an overview of what we normally refer to as the buyer-seller paradox. So normally when you have a business, let's say it's a limited company, and the seller will often want to sell the shares, the share capital of that company, because they can get favorable entrepreneurs relief. Now, historically, the buyer, on the other hand, doesn't necessarily want to buy the shares in the company. They want to buy the trade in the company, because with the shares you get all the historical stuff as well that goes on, the liabilities, in addition to all the trade. So often the buyer will just say, look, I want the trade only. Now, from a tax point of view, another reason why the buyer would want this is because for many years you could write off the cost of buying the trade against the profit of your business. If you're the buyer, that goodwill, the trade that you're acquiring off the seller, you get tax relief for it. So this video is all about the tax relief on that, the so-called goodwill amortization. Now, that buyer-seller paradox, what relative pros and cons have changed slightly in recent years because that tax favorable write-off of goodwill for the buyer no longer exists. There was a window of more than 10 years where it did exist, and today's video we're going to talk about something that happened in that regard, but now that avenue has been closed off. So the disparity between the buyer-seller paradox is not as great as it was, and I think a lot more buyers will go for the share purchase route because they can't get the goodwill write-off that they once had. So anyway, let's have a look at this particular circumstance. Now, one of the things that gets me excited as a tax advisor is when I come across reading court cases and decisions in the courts. And I've said this umpteen times that the law is not black and white. It cannot cover every possible scenario, and hence we have to go to the courts for the tribunals to determine what was the meaning of the law. And it always interests me when I see particularly famous people go to court, whether it be sports people or rock stars or TV presenters or film stars. And I was just reading something over the weekend, and what caught my eye was something a bit closer to home. It was an estate agent firm in my part of the world that I've known for years, and I thought, oh, hang on, what's going on here? Why is this estate agent business that I've known about, why is it in the tax tribunal? What is the point of law at stake? And the point of law that was tested with this estate agent was this goodwill amortization. So let's just have a look at the timeline here. Always got to start with a timeline. So you got two guys that went into partnership as estate agents in the 1990s. So in the 1990s. Now, crucially, they went into business before 2002. Because in 2002, that's when this regime kicked in of being able to write off acquired goodwill against your corporate profits. If you're a corporate buyer, you buy a trade, you can write off goodwill. And it lasted from 2002 to 2014. So you had over a decade if you were buying a trade, a business to do this. Now, so these guys are in partnership, and then what happened was they fell out. They fell out around about 2010. So partner A says to partner B, said, look, I'm going to pay you best part of $500,000, 450,000 for your 50% share, being your share of the market value of our partnership business. So, they said, look, this thing's worth just under £1 million, our estate agency business. And partner A says to partner B, said, look, off you go, but I will give you 450 grand for your share. So what exactly is he buying? Well, he's buying goodwill, the goodwill of the share of the business that belonged to his partner who's gone off into the sunset. Okay, so that's what happened. 2010. Then, what happened in 2013? Partner A, who now is no longer a partner, he's a sole trader because he's the sole guy, he incorporated that estate agency business. So in other words, he turned it into a limited company. And one of the things that you can do when you or you could do before they changed the rules, that you sell goodwill to a limited company, again, you write off that goodwill for tax purposes over several years. So 2013, he incorporated the sole trader business, and he said, right, I've now got on my balance sheet this amount of goodwill. Now, some of the goodwill obviously related to, his share that he had since the 1990s. Now, you can't write that off because the rules said that you can only write off acquired goodwill, okay, when you acquired it since 2002, but you still can't write it off if you acquired it from a related party that was in existence before then. So in other words, his share related to the point before 2002. So when it came to him setting up a limited company, he couldn't get tax relief for writing off his share. So what he did on his balance sheet, he said, look, let's take these numbers. He got 900 grand, 450,000 is so-called pre-2002 goodwill, relates to his share that he had since 1992. He said, fine, I'm not going to get any tax relief writing that off. But then he said, look, this 450 grand, the other 50% that I acquired from my business partner when he retired in 2010, I'm going to write that off against profits of the limited company. I'm going to get tax relief against corporation tax. So 450 grand, let's say try to write off 100 grand a year over 5 years or whatever. Well, that's going to save him 20 grand a year in corporation tax. Very good. But that's how the rules worked. Like I said, since about 2014, a little bit further on this time horizon, the government changed the rules and you can't do that. But for that decade or so window, you could get this brilliant tax write-off for acquired goodwill. Even if you acquired it from a related party or your own sole trader business that started since 2002. But remember, here we're in a hybrid situation because his half, he's saying, no, that didn't start between since 2002, but the bit I acquired from my business partner, that is post 2002, and I'm going to write it off. So HMRC opened an inquiry and said, oh, hang on a minute. No, you can't do that. We're not going to give you tax relief on writing off half of the goodwill that relates to what you bought from your former business partner. No. And the thing went to the courts, and the courts sided with HMRC, and the taxpayer, one half of the founders of this estate agent that I know very well, lost the case. Why? Because an interesting point that was argued in the courts was that, listen, the 50% that the guy bought in 2010, even though it was after 2002, it's still related to something that had been in existence since way back here. So in other words, you can't just sort of divvy it up and say, well, yes, I'm buying his share and it's brand new goodwill that was, created after the new change in regime in 2002, which allowed you to write it off against tax. The court said, look, I could, obviously you can see what he's trying to do, but they said, no, listen, what you bought was a share of something that had already existed. That goodwill had already existed. Yes, it might not have been worth as much down here as it was there when you bought it, but it still existed before 2002. And the rules say that acquired goodwill, if it was bought after 2002, still cannot be amortized if it relates to a related party arrangement that was in existence before 2002. So in other words, the genesis of the goodwill that he bought, he didn't just buy it from scratch there. I mean, yes, he bought it there, but the actual asset had its genesis back here. And that's what the court said. So look, you cannot, for that reason, get tax relief. You cannot write off 450 grand against your taxable profits of your new company over so many years because it falls foul of the Goodwill Amortisation rules. So an interesting topic there that caught my attention, particularly because I'd heard of the estate agent. Like I said, it always gets my attention when I see cases in the press that I know the people they're in or know of them. But just a little food for thought. Now, fast forward, like I said, now they changed that amortization rule. So let's just assume that going back to this, had he have acquired another estate agent business, unrelated, from another, nothing to do with the one that he set up with his former pal, had he acquired a separate one in this time frame, he would have been able to get the relief. The whole point was that it was related. Now, the rules have changed in about 2014 that even a genuine third-party acquisition, you can't write off against tax. Hence, coming back to my point at the top of the video about the buyer-seller paradox and the narrowing of the cost-benefit and the differential thereon, because you cannot get that tax relief. However, only in the last couple of years, the government then introduced a new form of tax write-off for intangibles, but it's not for goodwill. There's a certain limited few intangible assets that if you buy, you can write them off against your company tax bill, but goodwill not being one of them. So yeah, it's just an overview there on goodwill amortization denied. If you like this video, please do subscribe, and as always, I will see you soon.